Hello YouTube, 24K back, which this is a little bit unusual, but I thought it was time to preach with the prices going as low as they are. I've been getting a lot of questions recently about, where I think price is going and stuff like that, and I usually don't like to get myself involved with that. If you guys have been watching my channel, you know that I buy almost at every beginning of the month. I buy almost throughout the month, but I just buy. I don't really continuously look at spot price, and the reason being is just because I have a long-term plan for this. It's not short-term. Even if in an emergency, I don't need to sell my precious metals. I have a savings and I have other investments that I can tap into. So let's just get into it. I just thought give you a little explanation of why I do what I do and how I feel about gold. So to start, just to clarify that the gold market is very unique, and it cannot be compared to any other market like potatoes or sugar or anything else like that. The primary differences lays in the fact that gold can't be consumed, as it doesn't corrode. All gold is immortal and can be recycled indefinitely. I mean, 99.99% of the gold that was dug up thousands of years ago is still on Earth. We humans can lose gold, but it can't vanish. We lose it, but we find it too, because you see all these shipwrecks and so forth and so on. People digging up their old backyards, and somebody 100 years later comes down and finds it. Therefore, all gold mined is added to the total above ground stock. In contrast, potatoes have a limited lifespan of itself, and when eaten are digested. Really, supply and demand of potatoes or sugar is determined by what is produced versus human trends that set our need for consumption. Derivatives can be used by bullion banks and central banks to influence the price, subsequently influencing technical analysis and sentiment on which the rest of the market reacts. People can be scared to sell. However, when the price in the paper markets or derivatives moves up or down, no physical owner of gold is forced to sell at the paper price. So what I'm trying to say here is that if you're not selling, they can't control the price. You can hold off. That's the difference. If you've got a savings and you've got enough that if you lost your job or in case of an emergency, you don't need to go sell your precious metals, this could be a very good long-term investment, because we see the cycles that are there. It's very cyclical. So if you're able to hold off or even pass it on to the next generation if the price didn't reach what you wanted, there will come a time where they'll be making a good amount of money off it. So if the paper price goes down and the physical demand increases, this has to be met by equal physical supply. That is, if the price of physical gold follows the paper price. If the physical price disconnects from the paper price, premiums will appear at one location. And we see that. We see when the prices fall, and we've seen videos and other YouTubers discussing it, prices are continuously falling, premiums have gone up. So again, the reason being is because, and I have this in my market where, I went in at one point when, platinum was near 900, and I said to the, shop owner, I'd like to buy platinum at 900, and he said, I'm not selling it for below 1100. And all the shops did the same thing. They basically stated that we're not selling it below 1100, so you couldn't get it for below that price. Additionally, many other aspects determine the volume of supply and demand, the price. To name a few, you've got technical analysis, monetary circumstances, inflation, strengths of alternate currencies, which is really interesting, because if you go look at alternate currencies and the price of gold, you'll see that they've actually improved. Not in all currencies that gold has lost its value or lost as much of its value as it has in the dollar. You also have industrial applications, supply and demand data, for example. And we know this, there's been a couple of YouTubers who have done, great videos talking about China and the economic downturns in China and the manipulation that China, basically has over how much gold it is consuming. So if China is buying 2,000 tons of gold per annum, but analysts worldwide state for whatever reason that the Chinese are buying 1,000, maybe because that's what the Chinese are stating, this leads to distortion of sentiment as the market will react on false assumptions. So just to give you an example, that in 2013, the price of gold made a spectacular nosedive, which was followed by an even more impressive exodus of physical gold from Western vaults to China. So in 2014, the UK exported 1,424 tons of bullion, while China imported 1,507 tons. We also have to remember that China is the largest miner of gold at 450 tons a year. So to satisfy the domestic demand, additional gold is imported. So we know that in 2013, 1,507 tons, and in 2014, approximately 1,250 tons have been imported. And we will wait to see what the figures are this year. But again, as we know, the Chinese have always tried to manipulate, for some reason, the amount of gold that they're buying. They seem to not want anybody to know. It's a secret, part of their national interest, I guess. Now, I want to take this a little bit beyond and talk about some of the myths that we always hear. The first one being that rising interest rates are bad for precious metal prices. It's pretty surprising how persistent this myth is, given that gold and silver experienced one of the greatest runs during a period of rising rates. So that was back in the late 1970s, and Bill Lang talked about this on more than one occasion, when bond yields surged into the double digits. So we've seen where interest rates has gone up, but so has the price of gold and silver. You just have to go back and look at some of the charts. Although today some of the analysts are invoking the threat of the Federal Reserve rate hikes as a reason to avoid precious metals. Of course, it remains to be seen whether the Fed follows through on its rhetoric about higher rates later this year. I mean, they've pushed this from, June to August, September. Now we're talking about December, and we see the price of gold again going back down. And then when it doesn't happen, you see the price again rebounding. But nominal interest rates do not determine whether precious metals are more or less attractive than interest-bearing debt instruments. What matters is whether real estate rates are positive or negative. Now, this is just my way of looking at things. Negative real estate rates, which occur when rates are running below the inflation rates, are favorable for precious metals. So interest rates could skyrocket at the same time as precious metal price rise. As long as rate hikes are behind the curve, gold and silver will have a tailwind. The second myth is that the government raided all safe deposit boxes to confiscate gold during the 1930s. And although it is true that President Franklin Roosevelt's Executive Order 6102 prohibited the hoarding of gold bullion and ordered citizens to surrender their gold bullion in exchange for cash, but it was this 1933 directive relied mainly on voluntary compliance. It actually didn't authorize government agents to conduct random sweeps of bank vaults. Some safe deposit boxes were indeed seized as a result of bank failures, but gold confiscation only took place on a very small scale. Many Americans who held gold in their own home safes simply ignored the executive order. Government officials back then had no ability to keep tabs on individual bullion owners, and it doesn't today either, provided that you buy your metal directly from a dealer and hold it outside of financial account structures. Again, if you're buying in cash, no credit cards and so forth and so on, how do they know what you own and what you have? The U.S. government claims the authority to expropriate any private assets in a time of national emergency, but the likelihood of another government demand on citizens' private gold seems very low. And the reason for that is that the dollar is not on a gold standard anymore. So the restraint of gold backing no longer limits the issuance of more dollars. So, we've already seen that, where they continuously just continue to pump out more money. So it makes no difference for them to confiscate your gold. Unless we went back into, they put gold back as money. Myth number 3, and you hear this all the time: numismatic coins are confiscation proof. This particular myth is spread by rare coin dealers who sell heavily marked up numismatics, or collectible coins made from precious metals using false pretenses. In the first place, mass confiscation of any type of gold coin seems a remote possibility now, as discussed. Second, there is no law that explicitly exempts numismatics from a future order prohibiting gold ownership. And the fears of confiscation stoked by numismatic coin promoters keep you up at night, then you can simply opt for the U.S. Mint's American Eagles. They are considered to be legal tendered coins in the U.S., which would seem to provide at least some legal barrier to any potential gold prohibition effort. Premiums of gold eagles are only slightly higher than for most other bullion coins. With rare coins, on the other hand, premiums can be multiples of the actual metal value. So if you're scared that, that is the reason why you're holding numismatic coins, is not because you like them or because it's because you feel that the government is not going to be able, then why don't you just get maple leafs or anything that has a monetary value on it? It's money. I mean, when was the last time we saw the U.S. government confiscate money? Myth number 4, and you see a couple of guys talking about this, go get some gold mining stocks because they deliver 2 to 3 times the gains of gold bullion. Again, all we have to do is go back and look at the charts and read the history. It is a demonstrable fact that long-term investors have actually fared better with gold bullion than with gold stocks. Not only is bullion less risky, it's also been more rewarding. From 2000 through 2014, gold gained 309%. Over that same period by how much did the mining best those gains? Actually, they didn't. So from 2000 through 2014, the benchmark HUI Gold Stocks Index managed a gain of only 122%. And when prices of gold were falling during the 1990s, gold mining stocks fell even further. So during favorable upcycles for mining equities, they can potentially deliver outsized gains compared to the metal itself. But during unfavorable periods, the downside for gold and silver mining stocks is much more severe than it is for the bullion. Only when you look at the fleeting shorter term time frames do the miners sometimes deliver their fabled upside leverage versus gold. Thus, while mining stocks can be attractive at times for speculators or traders, they aren't suitable for most buy and hold investors. Myth number 5, the powers that be don't want gold to go up, so it's futile for the little guy to invest in it. Yes, price manipulation does take place, not just in the gold market, but in many asset markets. Over the past couple of years, interest rates rigging scandals have roiled markets across the globe. Technically, there is no asset class that is safe from price manipulation. The Gold Antitrust Action Committee and its many supporters insist that manipulation is orchestrated by arms of the U.S. Treasury Department and the Federal Reserves to artificially suppress gold and silver prices. Others in the hard money community doubt that manipulation extends much beyond a few opportunistic rogue traders who don't care which direction metals prices go beyond any given day. We have to remember that a delay in rate hikes until December, which was September, has already been priced in. So, they keep saying it and it keeps bringing the gold price back down. Oh, the interest rates, but that price was already calculated into it last year. And for all we know, rate hikes might not be even, with all what's happening with China and other world economies. You see the amount of refugees now floating into Europe. There's going to be a huge government spendings. QE is already rolled out again in Europe, again in Japan. So, we might not see even an inflation hike for 2015 or even, 2016. While weak equities could trigger a rise in safe haven demand for gold. So basically, I just wanted to take you through my thinking, my idea. I don't believe in the myth, that I've talked about. Don't let people push you in a direction because of scare tactics or because you think this is a great way to make a quick buck. It really isn't. If you do it that way or that's what you're thinking of doing, then you're just basically gambling. You might as well just take your money and go into Vegas. All right, guys, thanks for watching.